All right, in this video, we are going to talk about your credit score, what it is, and why it matters. Now, the best analogy that I can find for what a credit score is it's like going to the doctor and getting your blood pressure checked. It tells you the cumulative effect of a lot of factors. Now, we know that when it comes to medicine, part of those are genetic factors that we can't do anything about. But blood pressure also has an indication of how we eat and how we exercise. Those things affect our blood pressure to some extent, right? Well, your credit score is really a look at your previous credit history. How responsible have you been with borrowing money in the past? Now, it doesn't tell lenders how responsible you're going to be in the future. But for lenders who may or may not have a relationship with you, it tells them what your experience has been in the past. It's like a report card on what you've done with credit, okay? And all the decisions that you make will impact it. Now, why does it matter? That's a very simple explanation of what a credit score is, but why does it matter? Why is it even worth talking about in the first place? Well, two reasons. Number one, it will determine whether you are able to borrow money. And number two, it will determine how much you will pay for the money that you borrow. So let's go back and talk about that first reason why it matters. It determines whether you will be approved for credit in the first place. So let's say that you need to buy a car, you don't have enough money to pay cash for it. You will go and apply through maybe the car dealership or maybe through your local bank. And if your credit score is too low, you will not be able to get a loan, because the bank is looking at that number and looking at the probability that your past performance is going to indicate your future performance. That's the best that banks really have to go on. And so if it's low enough, they're going to think, well, this person may not pay us back. We may have to repossess this car. And so we're not going to extend credit to them. So there's a certain level, and we'll talk about those ranges in a little more detail in a few minutes. But the variability to get and borrow money in the first place is going to be determined by your credit score being at least decent. All right. Let's talk about that second reason why it matters, that it's going to determine how much you'll pay for credit. There's a really wide range of interest rates that are often assigned based on your credit score. So if you have a really high credit score, your interest cost is going to be a lot less. Whereas if you have a lower credit score, you're going to pay more in interest. It costs you more. Why do banks do that? Well, again, they are trying to implement risk-based pricing. And what that means is they want to equate the interest rate with the amount of risk they're taking. They also know that the higher your credit score is, the more options you have to shop around. And so they're going to be really competitive on those higher credit score borrowers to make sure that they're able to get that business, and they're competing against a lot of options. The lower your credit score goes, you have fewer options. There may be some banks that won't approve you, some banks that will. It depends from bank to bank on how low they'll go on credit score, but those rates are higher to offset the additional risk that they perceive that they have. Okay, so not only does your credit score matter for borrowing money, it matters for how much you're going to pay. So it really is worth your time and attention to figure out what your credit score is and to talk about ways to improve it. All right. In the next video, I'm going to talk to you about the ranges of credit scores and how you can improve those.